the dollar because there are so many headlines about it, and you can see it has had a correction. It has not broken its uptrend for the last 15 years. It's probably in a new range. Bitcoin to gold, so has not broken its uptrend, but has had a setback in here as Bitcoin has settled down and gold has continued to go up. Our bet is that Bitcoin will continue this uptrend over time.
Cathie begins with the U.S. dollar. For 15 years, the dollar has remained in an uptrend against both major and broader trade-weighted baskets of currencies. Recently, it has corrected, but crucially, it has not broken its long-term uptrend. Her view is that the U.S. dollar is entering a new range, reflecting the resilience of the U.S. economy relative to other regions. Why? Because if her thesis is correct about a supercharged innovation-led expansion, the return on investment in the U.S. will rise relative to the rest of the world. Stronger returns attract capital, and capital inflows sustain dollar strength.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Keep us honest. I feature the dollar because there are so many headlines about it, and you can see it has had a correction. It has not broken its uptrend for the last 15 years. It's probably in a new range, but we think if we're right about this supercharged or turbocharged expansion with innovation at the leading edge, we think that the return on investment associated with that innovation and with these new tax laws and with the deregulation is going to go up. The return on investment in the U.S. is going to go up relative to that in the rest of the world. Here you can see the trade-weighted dollar from a different angle. The previous one, this one, was based on 6 major trading partners. This is 26 trading partners, and on that basis, again, the uptrend has not been broken. We are in a little bit of a range. Just showing you corporate profits, how healthy they are, and this is the best measure of profits. It's adjusted for IVA and CCA, and that means it's adjusted for distortions associated with both inflation and deflation. So these are real profits, and they look very healthy. Now, we know that a lot of companies have not been investing enough for this new age, and it could be that margins come under pressure for that reason. Here is the same for the S&P 500. It has been obviously helping the stock market. We think quality of earnings is going to become very important moving forward, and those harnessing new technologies and driving growth that way are going to, we think, are going to benefit mightily. Here is that metals to gold index. I will say it's curious, gold breaking out to all-time highs relative to metals. What is that telling us? I still keep in the back of my mind, is there something, is there a deflationary bust out there that's causing this and fears associated with it? Maybe in China. I don't know. I know that the property cycle has not gotten better there. And we also know that investment spending is still up to 40% of GDP in China. We're only at 18% in the United States. So there are still excesses. They're funding a lot of things, including nuclear, and we think that's good, and all kinds of power, that's good for their competitive advantage. But to get to 40%, I have a feeling there's a lot of wasted spending going on, and that is a recipe for deflation longer term. The bears are saying we're going back into the 70s and just a bust on this basis, meaning S&P pricing going down, collapsing relative to gold. And you can see there's a tug-of-war taking place here. So stay tuned. On this basis, it looks much more hopeful, and especially because OPEC is saying that it wants to increase supply even more. So this is the S&P price relative to oil, liquid gold. And so it is a leading indicator, we think it is, and points, we think, to S&P relative to gold moving back up. Bitcoin to gold, so has not broken its uptrend, but has had a setback in here as Bitcoin has settled down and gold has continued to go up. Our bet is that Bitcoin will continue this uptrend over time, but we are paying attention, trying to understand what is gold telegraphing relative to Bitcoin.
Evidence of this acceleration is already visible in the labor market. Even the unemployment report, Cathie notes, contains hints of structural change as automation, AI, and digital transformation begin to reshape employment patterns. For investors, this means massive opportunities. The companies harnessing these platforms will not just survive, they will lead the next era of economic growth.
Just keeping our eye on this target, 3% deficit as a percent of GDP. You can see we've seen a small improvement. Tariffs are beginning to impact the deficit or improve the deficit. They're running somewhere between a $400 and $500 billion rate. That's an annual rate. And that would get the deficit over 1 year to roughly 4.7, 4.8%. So continued progress we expect. This is a lightning rod issue for the markets, and it's because the interest level is so high already, higher, as many people know, than the defense budget, that it seems that that is going to be overwhelming. We won't be able to overcome this because just paying that interest bill is such a drain. And we are focused on it as well, but focused on ways to get it down to 3%. Tariffs will pick away at it, but we think much more important, besides the DOGE cutbacks, which are still impacting government spending with government layoffs featured prominently in the unemployment report. So those have a long way to go, actually. And then the other thing that we're focused on is real GDP growth. And we believe, as we've said many times before, that real GDP growth, starting later this year into 26, in time for the midterm elections, we think it's going to surprise on the high side of expectations, significantly on the high side of expectations. And so we think that is going to be probably the biggest answer to the deficit falling as a percent of GDP. This was also the answer in the Reagan years, moving into the Clinton years. There we ended with a surplus. And we do expect a surplus, maybe not in the next 3 years, but again, just like in the Reagan years, it takes time to turn the profligate spending around and correct for excesses. So within the next 4 to 5 years, we would not be surprised to see a surplus. Again, we're very dependent on real GDP growth. And as we've talked about many times in the past, we do believe that we're ready for prime time for all of the innovation platforms around which we have centered our research and investing for years. So robotics, energy storage, AI, multi-omic sequencing in the life science space, and blockchain technology. All of them are being catalyzed by AI. Of course, AI can't catalyze itself, but you know what I mean. All of the other platforms are being catalyzed, and I think The speed of change is going to be pretty shocking over the next few years. And there are shades of it, or signs of it, in the unemployment report, and we'll get to that in a minute. It is important in terms of attracting investment to the United States. Adjusting for what I just showed you in terms of the depreciation schedules, the effective corporate tax rate, the tax rate today is 21%, down from 35%. In the first Trump administration, he got it down to 21%. Now they're not operating on the tax rate as much as they are the effective tax rate through these depreciation schedules, and that will get taxes down to roughly 12%. I was just in Hong Kong, which prides itself on very low tax rates, corporate tax rates, and that has attracted a lot of investment. But if you look at the tax rates there versus in the United States, at an effective tax rate of 12%, we are below Hong Kong's 16.5%. I believe they have, for very low levels of corporate income, up to, I can't remember, 100,000, something like that, 8%. But beyond that, and that is what we're talking about, 16%. We are lower than the Hong Kong schedules. That's important and interesting. And we're about as low as Ireland. Ireland's 12, I think it's a 12% tax rate, has attracted enormous investment, particularly in the pharmaceutical area and the tech sector. And we think a lot of that investment, again, encouraged by the Trump administration in all kinds of ways, a lot of that will make its way back, at least partially back.
Cathie Wood's conclusion is not doom and gloom. It's optimism grounded in data. She envisions a turbocharged U.S. economy driven by technology, fiscal discipline, and competitive advantages that the rest of the world will struggle to match. For investors, the message is clear. Focus on innovation, position for growth, and prepare for a world that is about to change faster than most people expect.